Let's talk a little bit about where we are with European equities. European equities have come a long way very quickly. I think Friday we hit a bull market in the stock 600. Amazing performance off the lows we hit at the back end of last year. But the ECB is still banging away at this idea that it's going to hike and continue to hike and then continue to hike after that. Are those two thoughts on the same page? And if so, if not, where is the gap?
So the gap, I think, is that the central banks are focused very much on the rate policy that is designed to bring down economic demand or aggregate demand, and that should eventually impact earnings. But that's much harder to analyse, particularly for a global equity market like the European equity market. But it also translates directly into valuations. So on the positive side, we've had reasonably robust economic data and surprises in Europe. It's certainly been a much better winter than most people expected, and that's very bullish. So the market has reacted to that and pushed up valuations. And what the central bank's trying to do is to remind people that actually leaning against that demand is rate hikes designed to mitigate, some of that growth and bring earnings down. So it's this trade-off between valuations and earnings that's very difficult for investors right now.
Given the rally that we've seen, have equity markets in Europe therefore gone too far?
Yeah, we definitely think it's too soon to be too confident. But we were at a place 3 months ago where when we look at our forecast distribution for where markets should be, the market was at the low end of the distribution. And simply what's happened is that through a little bit of positive economic news, perhaps the hint of a pause in some of the rate hiking that was causing valuations to be a bit cheap.
Bit of China.
We've shot, exactly, a bit of China, a bit of energy prices. The market shot through what we think is the right level, the middle of the distribution that we expect for this year, and is now sort of in the upper end of that distribution, a little bit overconfident on valuations and a little bit lacking in caution for the potential damage to earnings as we go through this year.
Well, and of course, one of those headwinds to earnings potentially, Gerry, and it's Kaylee in New York, nice to see you, could be currency. As we see potentially the euro could gain more strength if the ECB does indeed continue on its hiking path. How do you factor that in?
Yes, and I've been speaking to investors across Europe for the last few weeks, and I think it is underestimated. Investors got caught very off guard by the surge in European equities because of the low energy prices, as also the China reopening that's caused a lot of rotation within the market. What I think is being missed is this underlying slowdown in US demand and the commensurate change in the relative rate trajectory, where Europe is now hiking rates faster than the US and probably will be through at least the middle of the year before perhaps you even get rate cuts in the US that are faster than Europe. So, the strength in the euro we do expect to persist. At the moment, there's obviously a little bit of volatility because the Fed may end up needing to do a few more hikes after the strong jobs number on Friday. But if the euro starts rallying through 115 and towards 120 this year, that strong correlation of rising euro and rising equities, we think will flick back to normal, where a rising euro will actually be a strong headwind for the profits in Europe.
Okay. Taking all that into account, where does that leave European equities versus US equities? Because that's been the other big theme that has been running through markets over the last couple of months, this outpouring of flows from the United States into Europe. The last 10 years, we've seen European equity markets massively underperforming US equity markets. We didn't have any tech. Next 10 years, do we see a more evenly balanced performance picture emerging between the United States and Europe?
We probably need to see where we get to post-COVID with the China-US tensions to be talking about the whole next 10 years. But even if we're just talking about the next 12 months, Keith Parker, our US equity strategist, brilliant equity strategist, he and I actually have similar forecasts for growth this year between the US and Europe. That is minus 10 to 15% basically. And that's unusual. The last few years, the US outperformed because they had very strong growth that Europe wasn't able to match. But while we've got weak earnings expectations in both regions, the US, we think, still cheapens into the middle of the year, whereas Europe has already become cheap enough. So the outperformance we're seeing from Europe, we think, is justified. It's just that by the time we get to the middle of the year, we think the Fed might be pretty close to cutting. And as soon as you get those cuts, the market in the US that we think will be on a lower PE ratio by then should bounce harder than Europe. So it's a little bit of a tale of two halves, where European outperformance we can justify in the short term, but actually we think the US recovers very strongly in the second half of the year.
Gerry, I want to pick up on the China point, which you've alluded to a few times now. There's the idea of a tailwind from China reopening and that demand coming back, fueling growth, but then there's also the potential headwind of geopolitical risk. Does one entirely offset the other?
The geopolitical risk is much more long-term, I think. What's happening in China tends to be moderately important for the level of the European market, but it is much more important for the rotation, particularly because what's being priced at the moment is a consumption-led recovery. So we've had the consumer durables and apparel sector as an overweight preference within Europe, and they've really shot the lights out. They've done very, very well year to date. In fact, they're one of the only sectors that has dramatically outperformed the broader market in Europe. Other China-sensitive sectors like materials and industrials, they're up, but they're just not up much more than the rest of the market, and reflecting that lack of Chinese consumption growth.
OK, let's kind of dig into that dispersion a little bit more. As you say, European equity markets have kind of swung from being kind of over here to being over here. We've gone from one end to the other in terms of the spectrum in which they're normally, we would expect to be operating. Within that, though, the sector story, as you say, has been...
The rotation is important, yeah.
The rotation's been hugely, and has been substantial. Where do you now see that rotation going? Are we going to rotate back towards the defensives that have been performing very well today? Healthcare, for instance, tracking sharply higher.
Yeah, so too many strategists, I think, talk about binary outcomes. We're in a downturn or we're in a recovery. When we look at the probabilities in our models, we're actually in a little bit of balance of both. About 55% downturn regime probability and about 35% recovery regime probability. But actually, recoveries can have strong upward momentum. So we're in balance. I'd call it regime flux in 2023. We're not expecting a strong recovery. We really need stimulus for that, and we're still in a tight environment. But in that balance, you need some cyclicals to be long and some cyclicals to be short, some defensives to be long and some defensives to be short. So for us, that means early cycle cyclicals like banks, consumer, retailing, and semiconductors become our preferred sectors. And the things we're a bit more cautious about are later cycle cyclicals like tech hardware in particular. In addition to that, they're also very euro-dollar sensitive. And actually, pharma is an interesting one because it's very dollar sensitive. It's our defensive that we think is going to be rather disappointing because it's over-owned and expensive. It's been underperforming already, and we think particularly because of its dollar sensitivity, that becomes a balance for some of the defensive sectors that we would prefer to be long. So a little bit of a balance as the regime shifts from downturn to recovery all the way through this year without one totally dominating the environment.